The hidden experiment: what if saving money actually cost you money in several advanced economies? Banks charged people for keeping cash in their accounts. Negative interest rates turned traditional finance upside down, but this wasn't just policy. It was a live experiment testing how people react when the rules of money change, and how much control financial systems can quietly exercise. Background: how money used to work for decades. The system was simple: savers earned interest. Borrowers paid it. Central banks adjusted rates to manage growth and inflation. Then the 2008 financial crisis shattered stability. Rates dropped to near zero, and trillions were injected into markets. Growth remained weak, and policymakers began considering extreme tools once thought impossible. Rise: the cheap money era. Negative rates pushed borrowing costs to historic lows. Stock markets surged, real estate prices climbed. Government bonds even offered negative yields, but banks struggled with profits. Pension funds weakened, and savers quietly lost purchasing power. Breaking point: when problems emerged, the expected economic boom never fully arrived. Companies borrowed but didn't always invest productively. Housing became unaffordable for many. Public trust declined as people questioned why extreme policies were necessary just to keep economies functioning. Hidden consequences: when interest rates rose again, the damage became visible. Debt levels were massive. Asset bubbles showed cracks. Wealth inequality increased dramatically. Markets had become dependent on central bank support, and stability looked more fragile than before. Failed fixes: central banks tried to normalize policy by raising rates slowly, but higher rates triggered market stress, housing slowdowns, and corporate debt pressure. The system had grown used to cheap money, making the exit from negative rates extremely difficult. Modern parallels and closing: at one point, over $18 trillion in global bonds had negative yields. Today, markets still depend heavily on central bank actions. 3 takeaways: the rules of money can change faster than people expect. Extreme policies create long-term unintended consequences. Central banks now hold more influence over markets than ever before. The negative interest rate era may be over, but the conditions that created it still exist, and if another crisis